Hello. Welcome back, students. This is Dr. Mercado speaking. Welcome to Accounting 1329, Payroll and Business Tax Accounting. This week, we are beginning with Chapter 5, which deals with unemployment compensation. Okay? Brand new chapter. Please make sure that you read the chapter before you attempt any of your assignments. Reading is critical to you understanding the content and then being able to apply it to the actual different scenarios. Okay? So this is Payroll Accounting 2023 edition, and in this particular lecture, we are going to be covering problem 5.6a. Okay, so let's jump over to the problem. So problem 5.6a reads as follows. Okay, in September, Manson Paint Corporation began operations in a state that requires new employers of one or more individuals to pay state unemployment tax of 3.5% of the first $7,000 of wages paid to each employee. Okay, this is per employee, 7,000. We're going to pay unemployment taxes on the first $7,000 of wages for each employee. An analysis of the company's payroll for the year shows total wages of $177,610. The salaries of the president and vice president of the company were $20,000 and $15,000 respectively for the 4-month period, but there were no other employees who received wages in excess of $7,000 for the 4 months. Included in the total wages were $900 paid to a director who only attended directors' meetings during the year, $6,300 were paid to the factory superintendent, and $2,000 in employee contributions to a cafeteria plan made on a pre-tax basis for both federal and state. In addition to the total wages of $177,610, a payment of $2,430 was made to Anderson Accounting Company for an audit it performed on the company's books in December. We are required to compute the net FUTA tax and the SUTA tax. So as you can see, this problem has a lot of information. We need to dissect the problem to figure out what information we need and what information is irrelevant to us at this point. Okay? So, before we begin, what is FUTA and what is SUTA? Okay? In your chapter introduction, it gives you a brief overview of the Social Security Act of 1935. Okay? So, it basically states here that the Federal Unemployment Tax Act, which is FUTA, imposes a tax on employers based on the wages paid for cover employment. It is not collected or deducted from the employee's wages. This is something that is paid by the employer. Okay? The funds collected by the federal government as a result of this tax pay the cost of administering both the federal and the state unemployment insurance program. So the FUTA tax is collected for the administration of the state and federal unemployment tax, programs. The FUTA tax is not used for the payment of weekly benefits to unemployed workers. Such benefits are paid by the states in accordance with each state's unemployment tax law. So the SUTA, which is the State Unemployment Tax Act, that is what is used to pay for unemployment benefits in case you lose your job. These unemployment benefits are paid out of each state's trust fund, which is financed by state unemployment taxes. So we have the two types of taxes, the FUTA and the SUTA. The FUTA is for the administration of the federal and state unemployment programs. The SUTA tax is actually used to pay out the benefits, and every state has different state unemployment tax laws and different requirements. But if you do file for unemployment, the monies that you receive is coming from SUTA, from the state unemployment tax. So please read over the entire chapter so you can become familiar with the information. I'm not going to do that for you. So let's begin our calculation. We first need to figure out our FUTA and SUTA taxable wages. So we're going to begin with our total wages. According to the problem, the company paid out wages of $177,610. And from there, we're going to make some deductions of items that do not pertain, that are not taxable for either FUTA or SUTA purposes. Okay. Now, the first thing that we have here, it says the salaries of the president and the vice president of the company were $20,000 and $15,000 respectively for them 4-month period. Now, we do know that we only pay taxes on the first $7,000 of wages. So these two employees made more than $7,000. So we need to calculate the excess. How much are we not going to pay taxes on? Okay. So I'm going to have less, okay, non-taxable portion of president's salary, okay. The president's salary was $20,000, and I'm going to deduct the $7,000, okay. That is my cap. So that means that from the $20,000 that they earned, we're only going to pay taxes for FUTA and SUTA on 7, okay? So that means that $13,000 are not taxable for FUTA and SUTA purposes. So I'm going to deduct those $13,000. This represents the portion that is not taxable. So we're starting off with our total wages, okay? This is the $13,000 is not taxable. We're going to deduct that because we're only going to pay taxes on the first $7,000. I'm going to deduct the non-taxable portion of the vice president's salary, vice president's salary. The vice president earned $15,000, and remember we only pay on the first $7,000. So the excess is going to be $15,000 minus 7. The excess is $8,000. So we are not going to be paying any FUTA or SUTA on those $8,000 of taxes. Okay. Now, we continue. It says here the salaries of the president and the vice president were 20 and 15. There were no other employees who received wages in excess of $7,000. So that means that the rest of the wages are taxable because all of the rest of the employees didn't exceed that $7,000 mark. Included in the total wages were $900 paid to a director who only attended director meetings during the year. Within the textbook, you're going to include that directors are excluded from coverage. Directors of corporations, unless they perform services for the corporation other than just required by attending or participating in meetings. The problem here says that we paid $900 to a director, and all that director did was attend meetings. Okay, so those $900 paid to that director is going to be deducted. That is not taxable for FUTA and SUTA. So we're going to deduct the $900. Okay. It says here $6,300 were paid to the factory superintendent. Do I care to know that? No, those $6,300 are already included in my $177,610. That employee made less than $7,000, so we're good there. We can get rid of that information. We don't need it. Okay, and then we have $2,000 in employee contributions to a cafeteria plan made on a pre-tax basis. Okay, so we made a contribution of $2,000 for a cafeteria plan, but they were pre-tax, so I need to deduct that payment because we don't want to include it in the amount that we're going to pay taxes on, because this dollar amount for a cafeteria plan is on a pre-tax basis. So we're going to deduct the pre-tax cafeteria plan. God, how do you spell cafeteria? There we go. Cafeteria plan. Okay. So we're going to deduct the pre-tax cafeteria plan contributions. Okay. So that is $2,000. Okay. So then that's going to give me my FUTA and SUTA taxable wages. Okay. My FUTA and SUTA taxable wages is going to be your total wages less all of these items that are not taxable. Okay. So that's going to give me an amount of $153,710. That is my actual taxable wages that I am going to pay FUTA and SUTA taxes on. I'm not going to pay my FUTA and SUTA on the entire 177,610. No, we had some items in there that did not apply to be taxed for FUTA and SUTA purposes. So now I figured out that 153,710 is taxable. I'm going to go ahead and I'm going to calculate my FUTA tax. Okay. And my net FUTA tax is going to be my 153,710 times my FUTA rate. Okay. In your book, we have a section that tells you the tax rate. It says that under FUTA, all employers are defined earlier are subject to a tax with respect to having individuals in their employment. The employer's tax rate is 6%. Okay? So we are going to pay 6% of the first $7,000 of wages. Okay? Paid to each employee during the calendar year. Now, below that, it talks about another thing. It talks about a credit against FUTA. Okay? It says here that the actual FUTA tax paid is usually only 0.6% since employers are entitled to a credit against their FUTA tax liability for contributions made under approved state unemployment compensation laws. Most of the businesses or organizations are set up under this program. The state unemployment taxes must have been paid in full, on time, and all the same wages are subject to FUTA tax. Okay? And the maximum credit is 5.4%. So my FUTA rate is 6. I get a credit of 5.4. So that means I'm only going to pay FUTA taxes on 0.6%. 0.6%. Very important. Okay. Very important that we read only on 0.6%. Okay, there we go. Only 0.6%. So we're going to go ahead and we're going to get the 153,710 times 0.6%. And let's see what my FUTA tax is. Okay. So 153,710 times 0.6%. And that gives me $922.26. Remember that amount, the FUTA tax is used to administer both the state and federal unemployment programs. Okay. The problem also asks to calculate the net SUTA tax. Okay. The SUTA taxable wages, we've already calculated them at 153,710. We're going to multiply that by the rate. In the problem, the rate provided for state unemployment tax is that of 3.5%. Okay? 3.5%. So we're going to multiply the 153,710 times 3.5%. And let's see what that gives us. 153,710 times 3.5%. That gives me $5,379.85. Now this is the dollar amount that is put into a trust account for when employees are let go of and they need to be paid unemployment. This is where they grab the money from the SUTA tax, from the state unemployment tax. Okay, so excuse me. The federal is usually lower because that's just an administrative fee to administer both the state and federal unemployment program. The SUTA tax is where we actually contribute into a fund account, a trust fund account. That way, if our employees are let go of and we need to pay for unemployment benefits, that is where the money comes out from. That is usually a larger amount. Okay, so this is my FUTA tax and my SUTA tax. Okay, those are my calculations. But in order to be able to calculate that, it is important that we dissect the information. We dissect the information to figure out what is it that we need, what don't we need. Always be mindful of that 7,000 cap. We only pay state and federal unemployment taxes on the first $7,000 of wages paid to each employee. If the employee makes more than 7,000, anything above 7,000 is not taxable for federal and state unemployment tax purposes. Okay? So that is it for problem 568. I hope this clarifies some questions. It is important that you organize your data. That way you can easily see and track what is it that you need to add or deduct in any case. Okay, so that is it. Please, I cannot stress it enough. Read, read, read. That is it for today. Have a wonderful day, and until next time.